Hey everybody, this is Jose. How are you everyone? We are about to get started. As always, it would be very good to have a quick sound check. A quick hello on the chat box would do. That would tell me that you hear me well and all is ready to get started. So please do that. If you can, type a quick hello on the chat box and we begin. Thank you so much. Thank you. Thank you guys. Thank you, Mark. Thank you everyone. Wonderful. Perfect. We have 5 seconds to go and we begin. Okay, everybody, time to get started with our top session. Welcome, everybody. Today is Aug-7, 2022. My name is Jose Blasco. As always, delighted to spend some time with you here in the live session, looking at, in this particular case, looking at top. Today, we're running the session over the weekend, as we normally do with the top sessions. So no need to rush. There is no trade to be taken. It's all about making sure it's all well understood. In that sense, please feel free to be interactive with me. And who is the old person? I'm not sure what you mean by that. Joe, how are you, Jeff? Good. Because I said all. Okay. Yeah. Yeah. We have Mark with us. We have Jeff as well. Based on the hellos I'm getting. Yes. Anyway. So as I was saying, feel free to be engaged during the session. You may have questions. As always, do not be shy to ask your questions. If you are watching this recorded and you have questions, you can certainly contact us as well. Email us or use the questions page on our website and present your questions to us so we can assist you and help you in this particular case with the top sessions, so we can help you to master the use of the platform, which obviously will have an impact on how you trade. Anyway, with all of this said, we have a financial disclaimer. I would like to highlight it on the screen as always. Please read it carefully. This is important information. It's being highlighted. It's fairly short, and therefore I'm counting on you all to read it completely. And with that covered, we are now moving to the agenda, which is, again, of course, as I said, we're going to talk about top. Often you cannot separate talking about the software and talking about trading. So sometimes we have a little bit of a mini lecture in the middle of the top presentation, if you wish. Sometimes actually it's not a mini lecture, it's a powerful one. It depends, it varies depending on the tools that we are discussing. But again, happy to help you with anything, guys. And if you have questions, let me know, even if they are not related to today's topic. Today's topic, by the way, will be to continue with the risk graph and more. We left the last top session with a partial discovery of the risk graph, so we're going to continue a bit deeper into that. But if you have other questions not related to this topic, let me know. If I can make time, I'll make time to talk about it. If not, at least I know I need to address that in a future session. Okay, so I know what you need, guys. Very good. So let's begin. And here is top. We have it on the screen. I was talking about the fact that the last time we were working on the risk graph, which is located there on the left side, on the left menu inside top. So if I was to go back to the risk graph, so here it is, okay, and we've been talking about many of the features built in the risk graph. We talked about the ideal strike zone, for example. We talked about so many things which are absolutely critical. Now there is one function that we never got to cover, which is, in my mind, one of the most useful functions of all, because in the end, a risk graph is a risk graph. It's very little that you could do inside of a risk graph that makes it different than what every options trader in the world would think a risk graph is. So, I mean, we got good functionality here. Again, the ideal strike zone, for example, is something quite unique and very powerful. But in a daily basis, when doing options trades, really, in my mind, one of the features which is the most interesting of all is the compare spreads, because it helps you to pick or design the most adequate strategy before you start trading, and or it helps you very much to manage your trades during the life of the trades and evaluate what I normally call options tweaks, or sometimes in a very informal manner I talk about massaging the trades, which basically it's a trade management approach to trading options, where Some traders will do nothing, right? Let's say you buy a call, most you can lose is what you pay for the call, and if you get to the target, you're gonna close it. Anywhere in between, you do nothing, you just wait. So that's a valid approach to trading, of course. But other traders, okay, and this is a bit more of my personality, we love to massage the trades during the life of the trade. So we lock in profits, we fight against maybe volatility not rising or volatility rising too much. Again, all of those depends on the option strategy that you use. But many times with those tweaks, you could certainly help very much an option strategy to either become safer through time or perform better through time, or many other possibilities, because really with options, the sky is the limit. So now, in order to be able to conclude what is best for your trade, either when you're building it or if you are managing it during the life of its trade, that's when the compare spread feature comes extremely handy. When you click on the compare button, where now here on the left, you have a blank area where you could insert new spreads to compare the strategy I got above, which in this case is a long call, with anything else that we could build here below, and compare the results and compare the risk graphs and compare the break-even points and compare everything, every characteristic of the options trade could be compared, which is very powerful. So this is really something that, in my mind, is one of the key features inside the risk graph, at least from a point of view of how often I use it and how much different it is compared to other risk graphs. So now here I'm starting with a long call. Maybe it's gonna be more interesting if I just build a quick spread or something like that. So let's say we plan on a target to be 420 on the S&P, and I'm just gonna build quick trade thanks to the strategy builder. I'm just gonna get one spread, whichever spread. So for example, a bull put spread, I'm gonna risk graph it. Okay, so now I got the same risk graph I had before. The only difference is that I got something a bit more interesting now. I'm starting with a bull put spread here on the top with a specific, set of parameters and Greeks and characteristics on how the trade functions. So let's say we're gonna separate this conversation in two parts. Let's say you are building a trade and you are wondering what's best for me, to do a bull put spread like the one I have using the 411 and the 414, or maybe it would be better maybe to rise my strikes a little bit or lower my strikes a little bit and see what the difference is and what's best for me, given my trade plan, my risk appetite, my account size, and all the various parameters that option strategies we have, including trading preferences, which obviously that should be part of the trading plan. So in that sense, I just clicked on the compare spread, and another very handy button is the copy primary spread. And here, for example, let's say I want to compare two bull put spreads, one which is a little higher, meaning a little bit further out of the money, in the money, one which is where it is, and then which is a little lower, which is further out of the money. So to do that, I'm just gonna copy the primary spread twice. Now I got three trades, okay? So the main trade, the original trade, and then the two that I copied, okay? So the primary and the secondaries, if I could call it like that. Also notice that the risk graph is showing now, you have those triangles here that allow you to hide it actually. So if you click on the right arrow, okay, the risk graph will go away. I mean, not fully away, but it becomes way smaller, which now allows you to compare the Greeks properly. So not only you compare parameters such as the cost or the credit created, but you can also compare the Greeks. So maybe this is a more useful view when it comes to again deciding which options trade is best for you. So again, in this scenario, I'll repeat it one more time. So we are comparing. We want to compare three bull put spreads. The one which was built by the strategy builder, where we are selling the 414 and buying the 411. But maybe you say, okay, but what would happen if I was to buy the 415 and buy the 412, for example? Click OK. And so now I went a little deeper in the money, and now the next case is, what if I was to go a little out of the money and do the 413 and 410? So we are still talking about three bull put spreads where we got $3 strike price increments from 410 to 413, $3 of strike price increment from 415 to 412, and $3 of strike price increments from 414 to 411. Of course, those are only $1 difference, so the differences are going to be very little. You can see that in the form of a credit, where the original trade would pay 126. Okay, that would be the credit collected. That's the meaning of the negative sign. That's a credit. So we would collect $126 per contract if we did the upper bull put spread. We would collect 130 if we do the one that is a little deeper in the money. Of course, deeper in the money, more premium. So instead of 126 is 130. And the one below, which is deeper out of the money, would pay only 120, which is a little less than 126. Why? Because it's a bit deeper out of the money. So now you could have this initial basic comparison on the right, and it's all about just comparing the columns. Maybe you are concerned about the volumes, the open interest, the implied volatility, so you can just compare. Okay. Of course, we are talking about, in this case, I'm looking at S&P, the S&P ETF. Of course, this is an extremely liquid asset, and therefore I don't think that any of the parameters that we see with open interest or liquidity, such as volume, will show poorly. But again, in other stocks, you may realize that, you know what, the 415 got extremely little open interest, or the 411 has a very wide spread when looking at the differences between the bid and the ask, which is this column here. So you may compare these values from here to here, and you may realize that, you know, there is a wide spread or a narrow spread, and you may decide, you know what, I was planning to do the option trade to be at the money, but I'm just going to go slightly in the money because then I get much less slippage. All of those things could be valid. Again, it all depends on your trading plan and your trading preferences, your trading rules. But the beauty of the compare feature is that now you are putting it on top of each other, and it's very easy to compare. That's why it's called the compare feature. Same happens with the Greeks. So you can compare the delta in this column, the gamma, the theta, the vega, and the rho. So you can compare all the Greeks, and again, I guess it's self-explanatory, even though the values are very similar. Again, because I only varied $1, when it comes to the strike selection when building these three particular trades. So obviously, if there is only $1 difference, then the Greeks are going to be very similar. But if you were to vary more, then the differences would be more. And again, this may help you to decide, okay, so this is the trade I want to take. This is the best. Okay. Now, the risk graph on the right, as well as the break-even, max risk, and max profit values are probably even more important than what we have on the left when it comes to comparing strategies. And in that sense, something that is very useful as well when looking at the risk graph here, something that is very useful to keep in mind is that this risk graph works like a chart. So you could draw on it, you could write on it, etc. So one of the things that you could do as well is that you could click on this button, okay, which is the button where now you're going to be showing the crosshairs and the data window. And now it's very useful that this data window shows up together with the crosshairs here, all right? The vertical and horizontal yellow lines there, right? That's the crosshair. And because the crosshair now shows up, so you can be maybe more precise at putting your mouse in a certain location depending on the risk graph. In the case of a spread, it's very simple. But for other strategies, maybe it's useful to you to have this box here and the possibility to move your mouse around, and everything gets recalculated for you inside this box. So all of this is important, okay? And of course, I didn't say it, but all of this is color-coded. So you got the primary spread comes with the color blue. Notice that the ones I added below have a different color, orange and let's call it pinkish fuchsia, right? Now, if I click copy primary spread, and I just keep adding, notice how the platform will add different coloring, green, red, purple, blue, but it's a different blue, etc. And as you keep adding, more of these colors will show up, which then allow you to compare. Like, for example, if I was interested to compare the orange color with the primary, so I would just highlight orange, and notice how the risk graph now shows as orange, which is very similar but different. Why is it very similar? Because again, I only moved the strikes by $1. So then the risk graph is going to be very similar. But notice how the risk graph has the orange color to be compared with the blue, which also the values for break-even, max risk, and max profit also have the blue color here, as well as below it has the orange color. So in other words, you know what you're comparing. So let's say based on your trading plan, what matters the most to you is the value of break-even. So maybe now you will look at the break-even values for the blue one, which is 412, right? And you will look at the break even for the orange one, which is 413, and you will be like, look, with the orange one, I need the stock to go higher for me to break even or better. So it seems that the blue one has a higher probability of profitability because the stock may not rally as much, and still I am in profit. This is, of course, taking into consideration the current price of the stock, which is the last, which is here, right, which is currently 413. So in other words, you need the stock to stay the same or rally with the orange color to at least break even, where with the blue one, as long as the stock stays above 412.74, which means that the stock could drop a little bit and still you profit. Well, what if you look at the pink one? Well, if you look at the pink one, then the break even happens to be 411, which is actually better than 412. So if your trading method was giving priority to break evens, for example, by using the compare feature, you may now conclude, okay, I'm going to use the pink one, which would have me sell the 413 and buy the 410. And that would be your spread. And now you are all set and you know what you want to do. And thank you very much, compare futures. Now, notice, and by the way, in a way, everything I said, I guess it's quite easy to absorb, but if I'm moving too fast at any moment in time, please let me know, and I'm happy to rephrase it or give you more examples. Okay, so let me know if you don't have anything to ask because it's all clear. Please type OK on the chat box. That would help me a lot to know that's the case. Thank you so much for that. Then we got the red X's here on the right. Okay, which this allows you to remove some of those additionally added strategies to be compared with the primary. Okay, so remember, the way I did it is by clicking copy primary spread, and after I copy primary spread, then I clicked on edit and I went to edit the strategy, right? And that's how I came up with all those results. Now, all of this implies that we are comparing different trades of the same strategy with different strike selection, different expiration date, whatever that is, but the same strategy, right? Which is not necessarily the case. Of course, if you copy the primary spread, typically you are comparing the same strategy with the primary, even though you could certainly edit now and be like, okay, what if on top of that, I'm going to buy another, I'm going to sell another put. And now you click OK. So now, of course, now you created a different animal here to be compared with the primary. So when you edit, of course, you can really act on creating very, very, significant variations. But another way to create your variations is that instead of click copy primary and then edit, maybe you want to build things from scratch. So maybe you're interested on comparing the bull put spread with what would happen if I was to do, let's say, for example, what if I was to do long call calendar, for example, okay, which is a very different strategy. Okay, so maybe that's what you want to do, and in order for you to build the strategy, it's easier to use the spread plus button and add whatever you want to compare from there, which could be any other strategy from the list, okay, or you could just add whatever, like a long call, for example, which is very simple, and then you can edit this and change it all. You can change the buy, you can change the sell, you can change the expiration date, you can change the strike, and as we discussed in prior sessions, you can add up to 8 legs, so you can make this whatever you'd like. Okay, so again, very powerful compare feature in order to identify what's best for you, especially in the world of trading options. You may have certain rules that imply certain requirements. Maybe you're shooting for a certain value of delta, a certain value of gamma, certain value of vega. You may have specific requirements that in the case of certain stocks are very easy to be met. For example, the S&P ETF, Apple stock, for example, those are extremely liquid instruments with many strikes, and typically it's quite easy to find what you want. But sometimes we find ourselves trading options contracts with expiration dates that only got strike price increments of $2.5 at a time, $5 at a time, or maybe the expiration date you are utilizing is lacking liquidity and you need to move into another expiration date that may have the liquidity but less amount of strikes. I mean, we know that, isn't it? Options, it's a very unique field where, on top of trading rules, we also often need to use common sense. And in order to apply common sense in an efficient way, we often need to do some comparisons that help us to understand what is it that we got in our hands, and beyond that, what's best for me given my trade, my rules, my trading plan, and my trader personality. Okay, so I'm basically done with the compare feature for when you plan new trades. I would now want to talk about the compare futures when you are managing trades, which is case number 2, as I discussed before. And I'm looking at the chat box, and I can see how you guys are all acknowledging that it's all good, following right along. I really appreciate those comments. Thank you so much, guys. Again, it may feel silly to you guys because if you are following along, you may feel that you don't need to say it, but the reality is that it helps me a lot to know that's the case. Okay, so anyway, so now let's talk about managing positions that you already have in your account. So this can be done. The starting point can be done in 2 different ways. So option number 1, which is probably the most classical or typical, is that you have your positions in your position panel. And if you have your positions in your position panel, so a very normal application would be that from whatever your position is, here is a bull put spread on Micron. So you would right click, okay, and call the risk graph from here. And the difference between this risk graph and the prior one really is that, notice here, when we look at the prices, we have the word fill, okay? And that's because it's coming from the my positions. Okay, I went into my positions, I right click, call the risk graph, and then it's giving me the positions with the specific price I got when I got into the trade, right? So if I edit, notice how here in the price it says field price. I didn't make this selection. That selection was there for me, and the reason why that selection was there for me, it's because I, again, one more time, right clicked in the positions panel, and from there I went to call risk graph. If I was not doing it like that, if I go back to my risk graph, the one I had before, okay, the one with a spider, let me maximize this again on the screen. So if I was to edit the spread, and even without editing, notice the word mid instead of the word fill. So if I edit the spread, here's my midpoint, which I could certainly change to fill price, right? And then if I type, I don't know, 3 and 4, 0.26, right? So now when I click OK, so now I'm going to be given the same credit of 126, but now the word I have is fill instead of mid. So again, those are the 2 starting points for you to work on your trade management using the risk graph. Option number 1, you have your position in the positions panel. You right click, call the risk graph. So whatever you get in the risk graph is your position with the real prices you got. Option number 2, you may be utilizing top as an analytics piece of technology, and therefore you plan your trades with top, but you execute using broker ABC. There are many brokers out there that allow you to trade options, so let's call it broker ABC. And maybe you are not documenting anywhere the trades that you are executing with broker ABC. You are just planning your trade with top, you execute the trade, and that's it, right? But let's say you have a series of rules. There are a series of rules that if something happens to your trade, then you want to go and manage. So in this case, if you didn't document your trades in the position panel, okay, in order for you to be able to reload on the risk graph the real trade that you had executed with trader ABC, so then you will need to build it from scratch, okay? And to build it from scratch, again, it could be done in many ways. I would say probably the easiest way to do it would be that, here are the charts, you got nothing. So you come to the risk graph, you just load the risk graph, And then from here, by default, it comes with the long call. So you just come in here and edit, okay? And let's say you are trading in your account with broker ABC, you are trading, using September 16 expiration, you are trading, I don't know, a bull call spread. So you would just add this, customize your strike. So let's say you bought the 410, and let's say you sold the 421. So let's say that's the trade you have, okay? And let's say you did that some time ago, and therefore the field prices are not 769 and 234, okay, which those are the mid prices, okay? So then what you would do here is, as I just did, change the prices to be field prices manually, and then you would come to the field price, and now you would input what the prices were. So maybe you do the trade at 669, and then your 234 was 189, okay? So if that was to be the case, okay, this is where you're at. You are in a trade where your field prices are those. Okay, again, I'm assuming that you were using broker ABC, and those are the prices that you got when you did the trade, let's say 1 week ago, whenever that was. And therefore, the cost of the trade was 480. Here are your break-even points, your max risk, your max reward. Everything is here, and it's probably what you observed when you were planning the trade, let's say a week ago, whenever that was, when you took the trade. But now the trade is live with broker ABC. Those are your field prices, and therefore now you can see here your real-time P&L, which is 54.50. So if you were to close the trade now, you will get a profit of 54.50. That assumes that the stock went a little higher since a few days ago. And now the question is, let's say you have a trading rule that tells you time to manage. Okay, and maybe time to manage means that you have a rule where when a trade starts moving in your favor for a little bit, then you ratio it. What does it mean that you ratio it? It means that you sell another call. So instead of finding yourself long one call and short one call, which is a bull call spread, then you sell a second call against the bull call spread, and you end up with a call ratio. Maybe that's your rule. Okay, so we're gonna assess now how we're gonna do that in a moment. Okay, question here from Joe. I notice if you type in your field price, it automatically changes the category. You're right. Good one, Joe. Good technique on how to save a little bit of time. Yeah, absolutely. You're absolutely right. So thanks for sharing. So anyway, so if I go back to my compare spread button, okay. So now the empty space here that we mentioned earlier is again available to us. And then the typical way on how to manage the trade you have is use copy primary spread. In this case, I would say 100% of the times you're going to do that. Why? Because you are going to start from here, right? In order for you to manage / massage the trade you already have running with broker ABC, again, you start from that trade. So in other words, copy primary spread in this case is the normal thing to do instead of enter the spread, right? Because that would be a new trade. So now, once you got there here, okay, so now you could evaluate different things. And here again, there are basically two cases, if you wish. So case number one is what I just said. You want to add something to the trade you have, okay? So for example, you want to ratio the trade. So how would you do that? Well, you would just click edit, click on add options leg, and of course the new leg I just added, make sure you change that to mid. So that one will simulate what happens if I add this one with a real-time price while the other ones I already had it from before. So if you do that, okay, so that's case number one. So here's the net result. Okay, so now the cost of the trade will go from 480 to 246. Okay, and now you're in a position where of course the maximum risk now is infinity. Why? Because you are net short a call, so it's a ratio spread. But now the maximum profits could be enhanced all the way to 800. The break even now becomes 412 instead of 414. So now you could afford the stock to go against you by $2, additional $2, and you will still be okay. Again, you have a change of risk profile and characteristics, and again, that's how you do it now. As we discussed before, in order to compare the spread, you would just look at the information on the screen, both the graphics as well as the information on the right with break-even, max risk, max reward, and the Greeks on the left, etc. Okay, and this is what you do if you want to add. Okay. But what if instead of adding, what if you want to subtract? Okay, how can you subtract something in a simulated fashion, in a comparable fashion, before you close those legs using broker ABC, right? Because again, we are evaluating tweaks, we are evaluating changes on your current trade before you execute the changes. So how can you simulate using this feature, the risk graph, that something has been taken out of the account? Well, I'm going to copy the primary spread one more time. Okay, and let's say what you want to do here is, let's say, for example, a new UFO form on the screen, a red UFO form on the screen that didn't exist before, and you were in this trade where you bought the 410 call, okay, and then you sold above the 421 call. Okay, of course, the stock went up, so this is making you money now, $54.50 to be precise, which is the value we see here on the right. And now, for whatever reason, let's say a red UFO shows up, an Elliott wave turning point shows up, that the market is going to collapse hard, and you are like, you know what, that's it. Now, instead of bullish and bearish, instead the whole S&P changed, the sector of the stock changed. Well, again, I'm just giving you ideas. This all depends on your trading plan, obviously, but let's say your trading plan tells you now, I don't want to be bullish anymore. Actually, now I'm bearish. And now you want to remove things. Maybe what you want to do is that you want to simulate what happens if I close the call I own, and instead, okay, I'm going to buy a call above, such as the 422, okay, which now this becomes a bear call spread, which a bear call spread is credit and, sorry for that, here, and, okay, not sure why it's not allowing me to type the ampersand. Interesting, for whatever reason it is not taking it. So, and bearish, okay, where the one we had before was debit and bullish. So now we are doing a much heavier conversion, which imply the closure of some units, in this case the 410. So how can you simulate that? It's not only about adding units, it's about simulating closing units to maybe add more or maybe not, but how can I simulate what happens if I close units? So again, everything starts with copy primary spread. Okay, so I'm going to do it again. Okay, so you come in here, click copy primary spread, and the moment you copy primary spread and you edit, so you add an options leg, of course, okay, and as we did before, of course, you're going to have to make that to be mid. This is exactly the same that you would do if you want to add, okay? But now the difference is going to be with your actions, okay? Buy or sell, and with your strikes and the expiration date. In this case, what is it that we have done? What is it that we have said? We have said that we want to close the 410 call. So the 410 call was a buy. So how do you simulate closing that? Well, you reverse it, which is sell. If I reverse the 410 call with the current price, which is the mid, right? So what the system will take here is that you have got rid of the 410 call, you have taken whatever profit that provided and run away with it, and now you are left with the 421 call short only. That's what this would do, okay? Again, re-adding the same unit that you had, in this case, the 410 call, re-adding that one. But instead of buy, using sell, and instead of fill price, using mid, it's quite, I would say it's quite clear, right? It's quite common sense. But again, if you never thought about it, if you are watching this recorded and you never thought about this, so this is important. So if you were to do this, that now the system is going to take it like you got rid of the call. So if you click OK and you look at the risk graph is the risk graph of a short put, short call. The risk graph of a short call is like that. Okay. So if you ignore everything on the screen and you only focus on my red lines and you just buy any options book in the world and you look at what's the risk profile of a short call, is exactly like that. Okay. So now what's the difference? This is a short call where you took, not only you have X amount of credit on this particular trade, which is $189 of credit, and the most you can make is $189. Actually, the most you can make on this trade is $289. not 189 but 289. And why is that? Well, because you are making $100 on the stock trade, on the call trade, given the fact that the stock has been moving higher. So notice that you bought this call at 669, you sold the call at 769. So you made $1 of profit on the call you bought and sold and closed in that simulation. So the system now takes that $100 profit and basically, while this is now pocketed, it's still used in the simulation, and it's telling you, look, instead of 189, you're going to make 289. Why? Because it's the 189 plus the 100 that we just got here. So the risk profile is indeed the risk profile of a short call, which is what's left. Even though the values are increased by 100 because that's the profit made by closing the call. But again, one last time I will say it, but the risk profile is the one of a short call, which then, going back to my point, basically tells us that what the system now understands is that this call was closed. And how does the system understand the call was closed? Well, again, it's all because you went from fill to need, and you went from buy to sell, while the expiration date and the strike is the same. Okay, so this is how you do it. So now if I edit again, now that I believe it's understood that by reversing the action and changing the price to mid, the system takes it like you are closing the unit. So if we wanted now to, again, as I said before, buy an option above 421, we say 422, right? So now that's going to be the risk profile of buying the 422 call and selling the 421 call with an addition, with an additional $100, okay? That's going to be the risk profile. So it's going to be a bear call spread with an additional $100 of profit, okay? So let's take a look at what happens if we do this. Okay, so this is what happens. This is a trade now where the maximum risk is going to be 15, okay, and the maximum profit is going to be 85. Okay, so this is the maximum credit to be collected, okay, that we collected. So that's the most we can make net, and since that's the most we can make net, and the distance between strikes is 1, so 1 minus 85 equal 15, which is the maximum risk. Okay, so you can see now the new risk profile being drawn, and it's all updated. And this is the way on how you handle a situation where you want to simulate closing units in order to re-enter units before you execute this trade with, let's say, broker ABC. Okay, cool. So you guys, I'm gonna have a sip of water here. If you could give me a quick confirmation that all is well understood, that would be indeed appreciated. Please do that. And we are going to continue with the next tool as you guys confirm that this is the case. So looking at the chat box now and waiting for your messages, guys. Oh, good. Got it. Okay, so if you happen to be attending our sessions live, okay, which obviously the majority of you live right now with me are, obviously you've seen me use that function millions of times, and probably today is a very simple review for you. Having said that, if you are new to watching this, I had to repeat multiple times the same thing with different words because this is not a feature that you find too often in platforms. And the way on how to simulate closing trades is something that is not too common. So in that sense, I wanted to explain it so you guys can utilize it to the maximum magnitude of the advantage it provides. Okay, cool. Thank you guys for confirming in the chat box. That all is good. Okay, so next feature that we're gonna discuss today that will take us to the end of the session is the skew feature, which is the one on the risk. We have the skew. Okay, And you may be thinking, Jose, you forget the spread select. I'm gonna come back to this, okay, because it's all related. So I'm gonna start with the skew, which is the one we're gonna cover for the remaining of the session today. And let me maximize this as I open it. Maybe, to be honest, we're gonna use a different symbol to do this analysis. Maybe I'll use McDonald's, for example. And that way we'll see a little bit more interesting pictures on the screen, because again, the SPY ETF is so amazingly liquid that it's almost like a book instrument with very little surprises, even though there are surprises, but very little. So the options queue. So first of all, what is this tool, and therefore what it is for? Okay, so the Skew tool is a tool that allows us to visually plot and analyze and examine the skew, which is something that affects options prices, that makes options prices to be, if I could use the term, even though it's a bit incorrect mathematically speaking, given the complexity of options pricing models, but if I could use it, guys, just for simplicity. So if you were to expect options prices to be linear in a way, okay, which we know they're not, right? But let's say you were to expect some level of consistency when you go from strike to from one strike to another. So let's say you're looking at McDonald's and you're looking at the 260 strike, and then you look at the 265, and then you look at the 270. Of course, the options prices are going to vary, and it's not going to be linear. We know that. But what I mean by linear here, which is an oversimplification, is that you would expect a change, but it's kind of like the changes you would expect from 260 to 65. Something similar would be expected from 265 to 270, and something similar would be expected from 270 to 275, and so on. And that's what I mean by linear. Okay, so you would expect something. Maybe a better word is consistent, or predictable, or logical, or something to be expected, right? But what happens is that the reality is that it's not like that. Okay, it's not like that. So first of all, there are certain behaviors in options trading which are quite generic. But even those behaviors in options trading which are quite generic, which deviate from that linear, expectable type of differences from strike to strike. Apart from those differences, which are the way on how options work, which I want to detail in a moment. On top of that, we often have what I like to call price anomalies, which means that now, even if you were expecting anything that is not predictable and everything else, next thing you know, you got a strike which is behaving in a way which is absolutely completely different compared to another strike, compared to all other strikes. And it's like, why is that? Okay, and that's why I'm calling it price anomalies. So again, the beauty of the options queue, this tool, is that we're going to be able to plot all of these, assess it, and identify opportunities which sometimes are either close to or actually can be called as arbitrage opportunities. That's rare, but sometimes we will find out. Okay, so I'm gonna detail all of this with a bit more order, so it's all well understood. But first, a question there from Joe. That's a way to track P&L. You can answer that after Q. Way to track P&L. Joe, I'm not sure I follow your question there. You mean tracking P&L through time? Is that what you mean? Tracking the P&L through time? Yeah. Okay, I'll get back to that in a moment. Okay, if that's what you're asking. So anyway, so going back to the skew. So again, forget about. Let me go ahead and try to minimize the information in the screen. Okay. Okay. So this is the least amount of data I can get on screen because I want to kind of like draw here a little bit. So now I apologize in advance, okay, because my drawing is not going to be perfect, but let's go for it. So again, in a perfect world, you can see here the skew tool is giving you prices on the bottom part on the vertical axis. So this is exactly the same as the risk graph. Okay, so if you look at the risk graph, right, and you look at the prices, the horizontal axis is prices. Okay, so it's the same thing. Now, on the risk graph, this refers to the prices of the underlying asset. Okay, the prices of the underlying asset. If I go back to the Skew Tool, the prices that we see here on the bottom part, of course, they are related to the underlying asset, but they are not the underlying asset. They are the strike prices of an option. Okay? So in other words, if we look at whatever we are seeing at around 260, that refers to the 260 strike. So it could be the 260 call, the 260 put. We'll talk about that later. If we look at the 270, we are talking about the 270 strike. No matter the current price of the stock, we are talking about the 270 strike, even if the stock is currently trading at 259. Okay, so this is what that refers to. Okay, so those are the strikes, and then in the vertical axis we have the percentage of implied volatility, which if I go check on an option chain on McDonald's, the implied volatility. So we have here a column which is IV for the calls, here is IV for the puts, and all the values that we find vertically speaking inside these columns. Okay, they are the implied volatility available for each of the strikes. So the 255 call that expires in August 19 has an implied volatility of 20.04. That's the implied volatility value, okay? Which I'm assuming that everybody understands the meaning of implied volatility, okay? So with that in mind, vertical axis is implied volatility, horizontal axis is strike prices. So if you were to plot how the volatility changes through strikes, typically you will end up with something that looks like that, okay, which is what is known as a volatility smile. Okay, and again, I didn't say it, but this dotted line happens to be at the money. So typically what happens is that at the money, you got this particular level of volatility, and then as you go lower in price, volatility is higher. As you go higher in price, I mean strike prices, volatility is higher too, and you get this volatility smile around, more or less centered with the at the money strike. This is kind of like a book explanation of what to expect. So you would not expect something linear, as I was saying before. You would expect something that varies through time, right? So again, another way to think about it is that you look at McDonald's, the implied volatility, the continuous implied volatility is 16.5. Another way to think about that is, let's load McDonald's. Let's take a look at the implied volatility. I have it on the left. Here we go. So the implied volatility here on the chart, obviously the what we see on the chart varies a little bit from what we see here, because this takes into consideration bid and ask prices and so on, which on the chart is close prices only. So we got 16%. Here is 16.5. Again, it's the same thing. So that's the implied volatility, right? So you may be thinking, if you were to be a new options trader, you may be thinking, okay, since the implied volatility is 16, which by the way, here's the dotted line showing you the 16, right? And here is the dotted line showing you the current price of the stock, and therefore the at the money strike is 259. So you would be thinking, so this is the starting point. And again, if you were to be a very new options trader and you were to expect everything is going to be the same consistently throughout strikes, which is what I was calling, incorrectly speaking earlier, lineal, but I guess that it makes sense from a graphical point of view. So you would expect something like that. Well, what I just said is that this doesn't exist, and you would normally see something like that. Okay, something like that, which is why it's commonly known that the behavior of implied volatility, shows a smile, right? And you may have read articles or books that talk about volatility smile and things like that. And why is this like this? Well, because again, implied volatility represents expectation of futures movement, and there is more uncertainty away from the current price than the certainty that there is close to the current price, and therefore the expectation at the current price may be more, how do I put it, more certain. This is extremely incorrect from mathematical point of view. I'm trying to simplify with the language, but hopefully I make sense by using terms of this sort, because later I'm going to explain it's not going to be like that. So that's why I want to keep it very simple in this initial stage. Where, if you are looking at other strikes, such as a 266, which is away from the current price, 259, so there is less certainty, there is more uncertainty, and therefore there may be more expectation. Okay, and that's why you would expect that volatility smile to be there. Okay, so well, everything I said is correct, but again, it's not exactly like that either, right? Because also in most cases, okay, the markets tend to go up, right? If you look at the S&P throughout the time, through our the decades and the decades, in the end, it just goes up, and there is a market crash and a 50% drop, like in 2008, or the pandemic and things like that. So next thing you know, the market turns and goes back higher and keeps going. So therefore, there is less fear, and therefore the expectation towards the upper prices typically is less. So while volatility goes up, it takes many more strikes to the right to get to a higher level of implied volatility rise. So it would be seen as something like that, where if the prices were to fall, fear kicks in, and therefore there is much more expectation of a price movement. Next thing you know, people don't expect that McDonald's will move at a rate of 70%, but people expect it to move at a rate of 18, 19, 20% immediately, and therefore the volatility smile will go like that. Right? So instead of like a symmetrical smile, something like this, okay, well, that's pretty okay. So instead, you get something asymmetrical, which is more something like that, putting on the side the poor drawing. Okay, but you get my point. So now this is more like what happens in the reality. So if I load, it's a 9 strikes. Okay, notice how this is more like what happens in the reality. Okay, but not exactly either. Okay, notice how instead of having a continuous move to the upside, so here you got this price anomaly, right? That line should just go straight up, right, and connect the dots, but it's not connecting the dots. It's creating this, weird value, just like this one or that one, right? So we could add more strikes if you'd like. Okay. Okay, we have many strikes here, and apart from calls, okay, I can also add the puts. Okay, so I can add calls or puts or both. The puts, just so you see, it's the dotted lines. Okay, those are the puts. Notice those price anomalies that happen. If I load calls and put both, so yeah, they tend to move pretty close to each other. But notice how, like for example, the differential between implied volatilities using the 335 strike for the call and the put using the August 19 expiration date, which is the red color. Notice how the difference is between 72.5 and 65. So we are talking about 7.5% difference, okay, between the call and the put. Okay, 7.5% difference. Let me type it again. 7.5% difference. Where if you look at the same strike, actually the same strike doesn't exist. I'll look at the 740 here, at the 340, with a different expiration date, which is the light blue, which the light blue is September, as you can see here. So if you're looking at this, so we are talking about a difference from 55 to 37.5, okay, which 37.5 to 55, that is 17.5, if I'm not mistaken with the math. So we are talking about 17.5% of difference, right? So notice how sometimes you will have expiration dates or strikes where the calls and the puts are behaving in a way which is very similar, and the expectation built in, it's what you would expect from the model. But sometimes the differences are huge, humongous. Okay, huge, humongous. So all of this, it's important to know and assess. Some options traders are trading based on this exclusively, right? They are only trying to spot large differences between implied volatilities between certain strikes, and then try to lock in those differentials using some combination of options. Where of course you're going to lose money on getting in and getting out, but if the difference is large enough, so you may end up with an arbitrage opportunity where you could enter a trade for a limited profit but with no risk. Okay, so those are actions that could be performed, and in order to find those, of course you have to plot it and visually identify those possibilities. Okay, Now, notice how, again, going back to this concept of my incorrect math when mentioning the term lineal. So 16.5, which is this dotted line on the bottom part here, that was the the CIV, the continuous implied volatility. Okay. Notice how in August and September the differences of implied volatility are significant, and as you go out, either above or below price, out in the money or out of the money, the differences are even more. And we do have in this particular case a pretty well centered smile, which, by the way, that is not the case for all stocks. So, for example, if we look at, let's say, Apple, uh, so you can see, for example, it's kind of like the not the opposite, but a little bit different here on the red color. So huge difference between the call and the put from an implied volatility point of view. Huge difference between the red lines, and then no difference at all for many strikes. Okay, and then almost every strike above price are different, but below price there are many strikes where there is very little difference. So again, depending on the strikes that you use, the performance of your option trades could be very different. But again, in this particular case, we have an example of what I was saying before, where if prices, remember this dotted line is the current price, right? So if prices drop, okay, if the stock goes lower, so you can see how the implied volatility just goes up with a different angle depending on the expiration date, but volatility goes up. Where if the stock goes higher, right? If we're looking at higher strikes, the implied volatility does not go up from here and gives us a symmetrical smile. It's giving us a symmetrical smile, but it's not centered around the current price. It's centered around a higher price point, which somehow it's telling you that the expectation for that stock is to move higher. And let's say a fair value for Apple to maybe taking profits would be around 175, okay, which is $10 above price. So that, by the way, it's another technique that could be employed to spot relevant strike prices where profits could be taken. If you load multiple expiration dates, now I'm going to add more colors on the screen, so it's going to be a bit busy, right? So notice how it seems that the majority of the change of direction from the smile going down to the smile going up, the majority seems to be happening around this price point, which is 177 something. So this could be seen as maybe the place where the market expect Apple to go. If we look at McDonald's, going back to the prior example, okay, notice how there are multiple expiration dates where the symmetry for the smile is happening from the current price, right? I mean, other expiration dates seem to turn a bit higher, but there are expiration dates that are turning at this price. In other words, it seems to be less clear on what's the expectation depending on the expiration date, but with Apple, it was clearer as a picture, isn't it? So again, I'm not saying that this is going to be an amazing life-changing technique on how to set targets. I'm just saying that these graphs where we are plotting implied volatility versus strikes for calls and puts, these graphs have meaning, have value, and therefore could be used in the context of certain option strategies. Okay. Jeff, how to apply Skew to our trade? I mean, there are many different option strategies on how we could do that. It's a very complex topic and it will not fit in today's presentation, but certainly I'm happy that you're asking this question. We could talk about that in the future. If you want to Google, just to get a little bit extra information, in case you haven't heard the term, there are funds out there, I'm talking about fund managers, that they manage what is called volatility funds. So I would suggest to go out there and just Google volatility funds or volatility option strategies and go take a look, because there are some fund managers which the only thing they do is to create option strategies that profit if something dramatic happens in the market. It's all about playing volatility, and obviously to build those option trades, understanding these skew graphs, it's absolutely critical. Okay, most of the option strategies used to play these powerfully are what we call back spreads, okay, which is a very complex option strategy. Probably one of the most disappointing option strategies from the point of view of it's very difficult to adjust a back spread to pay you unless something crazy happens. Right now, if something crazy happens, those back spreads tend to pay very well. So again, the magic there and the skill is to build back spreads which benefit great of those differentials and those price anomalies. For example, when you see things like that, right? That price doesn't seem to follow the blue line. So that price has a price anomaly. And if you were to use some of those strikes to build a back spread, which, as I said, is a very, very difficult trade to utilize and create profits with, but if you do it with strikes that have a benefit from a volatility point of view, so next thing you know, now the back spread is, if not free of risk, almost. And now it's kind of like a backup plan to have on your account. So if the markets just crash, collapse, and get destroyed, well, yes, you get hurt on equities that you may hold long, but then your volatility trade is just now exploding in profitability in a massive, massive way. Again, there are fund managers out there that the only thing they do is to build these type of trades, okay, and they sell their product to other funds, okay, maybe directional funds, equity funds that are trading portfolios where they hold many stocks. Maybe they are playing sector rotation, whatever that is, and then as a measure of kind of like a plan of contingency, they add volatility trades that would profit only in crazy cases of that sort. But again, to build those trades properly, you will need to benefit from these kind of things. Okay. Exactly, Joe. Exactly. Yeah, I'm reading your comment there about the trader from Goldman Sachs that uses Q as the main strategy. So this is a topic like we could certainly spend many hours talking about it. It's not an easy task, an easy topic, and it's also difficult really to exploit in a massive way in a retail account because normally to exploit this properly would require a very large size and again, lots of time in front of the screen, and also because of the differentials between the implied volatility are normally small because markets are efficient. So the way to enjoy this better is also with a very low commission model, and therefore often is better used by professionals running funds and so on. But it doesn't mean that there are no opportunities for retail traders as well, and that's why we are discussing this tool today. Okay. So anyway, so this is the tool, okay? And what the tool allows you to do is to spot what's the current characteristic, and therefore identify if you find or you don't find what you're looking for, depending on the trading strategy that you use to benefit from skew. Again, you could customize with the colors the date that you want to use, and you could certainly change the dates too. For example, maybe you are looking for a skew play, but you want to do it with a very long-term expiration date. Maybe you're looking at June 2023. So you would just change that, and now this orange color line now happens to be the June 16. If I change these to January 19, 2024, so now it's still orange, but now that I think I just got a problem there. I'm not sure what just happened. Oh, yes, I know what happened. Sorry about that, guys. Just looking at my other screen. Okay, so here, this is what happens. Sorry about that. Let me bring it back here. Okay, so bottom line, what I was saying is that as you change the dates, you maintain the color, but now the color has the meaning of the date next to it. Okay, and one more thing I would like to mention before we conclude our session today is that, well, I'm looking at new core here. It doesn't matter really. So now another thing that I wanted to mention is that apart from plotting the volatility, and this is, to be honest, this is a great example of what I said before, where you can see that when the markets fall, there is more volatility coming in. When the markets go up, people are more calmer, okay, or their expectation is calmer, and therefore the resulting implied volatility is less. But anyway, so the other thing I was going to say is that apart from displaying data from a volatility point of view, which is the values on the right, you can also display the data from a delta or theta point of view. So maybe you are looking for strikes that have a specific value for delta. And of course, that's going to be very difficult to find anomalies on delta. sometimes it happens. It would take a major, massive difference in implied volatility for this to be the case. I would say when you chart volatility, you kind of see what you need to see. But again, maybe you're looking for delta, maybe you're looking for theta. Okay, you can also see those values here very easily. And again, this is really depending on the option strategy that you plan to use and how you want to plot skew to help you find what you're looking for. Just like when it comes to skew type, okay, we are looking at strike, which is the values on the horizontal axis. Well, apart from strike, you can also look at time. So maybe you're looking at 5 different expirations. Okay, maybe you want to look at 10. Okay, 10 different expirations. So now you are looking at the volatility through expirations, okay, and for specific strikes. So you may be like, okay, I care now about what's the difference between the 140 and the 145, calls and puts, both, okay. So what's going to be the difference, okay, depending on the amount of days to expiration, okay, when it comes to volatility or maybe when it comes to the theta. And when you do that, you end up with different graphs that, again, right now this may be a bit overwhelming in today's discussion, but my point to making it visual for you guys is that depending on the option strategy that you use to exploit a specific positioning of the skew values, so then having the flexibility to change those settings on the drop-down menus would allow you to find and see what you're looking for. Okay, again, I would say 99% of the cases, this is going to be the settings that are the most helpful for most options traders, which is use strikes and volatility, and therefore the colors represent expiration dates. This is probably what gives you the answers you're looking for, but you got other ways on how to plot it, and certainly that could be useful too. Okay, cool. So basically we are done with the discovery of the Skew tool. Earlier Joe was also asking about tracking the P&L as you adjust trades. Okay, so to do that, I want to go back very quickly to the Micron trade that we have here, risk graph. Okay, and so let's say we were comparing, right? To you were exploring, maybe converting something, maybe you were planning to add another options leg with whatever that is. Okay, so what you could do is, again, the best way to compare P&Ls, at least what I like the best, is to activate the crosshairs and the data window, and then you are basically just moving your mouse right and left because the horizontal axis is the price of the underlying stock. So of course, at the current price, right, the P&L is going to be the same. The moment you enter the trade, the difference between the P&L now and later is going to be the spread you suffer. But since I have selected mid, so then that's not going to show on the graph, right? So no matter if you enter now or later, your P&L is going to be 8.5. Okay, so you have the same starting point. Okay, but the P&L through time, that is what is interesting to observe, right? And that's exactly the way you would do it is exactly the same as we discussed in the prior session about the risk graph. You can change the dates, etc., etc. But in this case, what's different is that you have the blue and you have the orange graph, both for expiration or the dotted lines represent on a real-time date. So you can either change the date manually. For example, let's say you care about A14, so change the date manually, and now as you move your mouse right to left, so here it's going to tell you on August 14 versus September 16, blue is 48, where orange is 271 in August 14 versus September 16, which is 430. So that's how you would do it. You would just move right and left with the data window. That's probably the best way on how to handle it as you are changing dates, if you need to change dates, or if you're just looking at today P&L. So it would be the dotted lines, and expiration P&L, it would be the solid lines. So that's how you do it. Okay. So hopefully this answered the questions, my friends. We surpassed the ending time of the session by 10 minutes, so we need to conclude the session. Thank you so much, everybody, for joining me today. As always, you know how special these top sessions are for me. It means a lot that you guys are making time over the weekend to join me and so on. Of course, if you're watching this recorded, I love you too. But again, I know that some of you are making an extra effort to join over the weekend. So thanks for that, and see you in the next one, everybody. You guys take care. See you soon, my friends. Bye bye.